Welcome, everyone. We're so happy to have you join us today. We have a great turnout for this discussion. I know this is a very in-demand topic. Many of you have reached out, and we're very excited to hear this discussion. I know I certainly am. So we can get to that in just a second. But first, I wanted to welcome you all again to this virtual discussion. My name is Jennifer Apicella. I am the Director of Partnerships and Programs here with the Pittsburgh Robotics Network. We welcome you to today's discussion. The Pittsburgh Robotics Network represents one of the world's largest robotics communities in the world. Many of you may already be familiar with Carnegie Mellon University's stellar leadership in computer science, robotics, research and development, artificial intelligence. But what is equally impressive is the significant depth and breadth of our Pittsburgh commercial robotics business community. So our regional community has over 100 robotics organizations that operate here within our region, representing over 12 different industry segments. So this is impressive and globally speaking, quite unique. We're very proud of this community, and we're proud of all the participants, many of whom are on the panel today. So this is also why Pittsburgh is referred to as the robotics capital of the world. Now, it's our mission to connect you, our audience, with this rapidly growing industry community and to work together to accelerate the overall adoption of autonomous systems. Now, if you'd like to learn more about us, we encourage you to stay in the know for robotics industry news, events, and other announcements related to this community. You can definitely check out our website at robopgh.org. We'd also encourage you to follow us on social media. We're most active on Twitter and LinkedIn. And we share a lot of information, news and announcements and updates regularly that are very relevant to robotics and the robotics industry community. So the links are in the chat if you'd like to just follow us there, or we've made it really easy for you. There's a QR code. If you want to pull out your phone, you can just scan that now, pull up our LinkedIn community, which we're very active on. There's a lot of updates going on there. And yeah, we would welcome you to engage with our content, follow us, share, tag us as well. So for today's event, which is what you've all joined us for, this is our Robotics Business Insights series, which is an exciting virtual panel discussion series, which is designed to help you and others learn more about the leaders in robotics and automated systems and what they're doing and what topics are top of mind to them. So this is what we'll be talking about today. The conversation today will be focused on robotics market trends and investment strategies. Now, before I turn it over to the speakers, I would be remiss if I did not recognize and thank some of the organizations who are our leading supporters. These organizations that you see here, they are the Pittsburgh robotics community, and they are leaders in their respective fields. So we've got academic and research superstars like Carnegie Mellon University and the University of Pittsburgh, which are both strong in generating top talent in this space. We've also got Denton's Global Venture Technology Group, JP Morgan, Cowen, Harris Williams, and Cascadia Capital, who are all global business growth leaders and valuable partners with companies in our robotics community and the global industry. And we also have our leaders in autonomous development, notably autonomous vehicle development, such as Argo AI and Aurora. So thank you to all of these fantastic organizations who have helped make this all be possible. Speaking of fantastic organizations, today's presenting sponsor is Cowen. So for those of you who aren't specifically familiar with Cowen, they are a diversified financial services firm that operates through two business segments, broker-dealer and investment management division. The company's broker-dealer division offers investment banking services, equity research, sales and training, prime brokerage, global clearing and commission management services. And Cowen's investment management division builds on their core insights by developing differentiated, actively managed investment strategies that seek to meet the dynamic needs of their clients. Founded in 1918, the firm is headquartered in New York and has offices worldwide. So if you'd like to learn more, there's a link in the chat. And we encourage you to check out, and if you're not familiar with any of these organizations, please do check them out. They are excellent. I'd like to introduce today's moderator for the discussion. Our moderator today is Peter Finn from Cowen. Peter Finn is the managing director in Cowen's Industrials Investment Banking Group. At Cowen, Peter leads coverage of industrial technology, where he focuses on high growth areas within the industrials landscape, including robotics and automation. So now for those not familiar, Cowen is an independent investment bank and a sustaining partner to the Pittsburgh Robotics Network, and is unique in their focus on delivering lifecycle services to high growth companies along their respective journeys. So with that, I will conclude my welcome presentation and turn things over to Peter to the panel as well.
Great, thank you very much, Jen. So as Jen mentioned, Peter Finn, I lead coverage of industrial technology within Cowen's investment bank. That means that I spend my time focusing on companies within high growth areas across the industrials landscape. That's addressing a number of themes that you'd be familiar with, including IoT, Industry 4.0, digitization of manufacturing, as well as robotics and automation. And specific to robotics, Cowen's focus is really platform-wide. That means we invest in robotics out of our asset management group. We publish thematic and company-specific research out of our research department, and then where I sit on the investment banking side, we engage with companies to deliver advisory and capital raising services as they hit different milestones along their trajectory. I should note that the opportunity to work with the broader PRN community is also of great importance to Cowen, both from a personal and institutional connection. Our CEO, Jeff Solomon, is a Squirrel Hill native, so he's very invested in continuing the transformation of Pittsburgh. That's been such a great success story over recent years. And as a firm, you know, we've gotten to know and work with many of the great companies within the PRN and the broader ecosystem. And so certainly want to extend our appreciation for all the great work that Jen, Joel, and the rest of the Pittsburgh Robotics Network are doing to continue that positive momentum. Before we jump into the discussion, I'd like to quickly introduce our panelists for today. First, we have Charlie Reverte, the Chief Operating Officer for Gather AI, which is a supply chain robotics company that was spun out of CMU by PhDs who built the world's first safe autonomous helicopter. We have Troy Demmer, who is the co-founder and chief operating officer of Gecko Robotics, which is a robotics and software business that helps prevent asset failure across a range of critical industries. And then we have Zach Barasz, who is a partner at G2 Venture Partners, leading West Coast-based VC, where he invests at the intersection of technology and sustainability across a range of markets. Before diving in, I'd like to give each of our panelists an opportunity to give some additional background on themselves, their companies, you know, the customer problems that you're addressing, anything else that you think would be helpful just to set some additional context as we dive into some of the questions that we're hoping to get to as part of today. Why don't we start with you, Charlie?
Hey, great. Thank you again, Peter, for hosting, and Jen for helping put this together. Really excited to be here. So a bit of my background. So I'm from CMU Robotics and ECE. I was born in the machine shop in Building D many years ago, but I plan to spend my career in robotics. Worked at Red Zone, you know, different startups in the area, Blue Belt, and I actually left the industry heartbroken in 2006 because I concluded it was not time, and there still isn't like a Google robotics, if you will. But I think that time's now. The industry's at a turning point, which we'll talk about more today. And I'm so excited to join Gather AI as president and COO. So what really excites me about it is it's a software-only robotics company that has all the properties that investors love, enterprise SaaS and B2B, but then has what we love from robotics, which is really deep technology modes and really game-changing technology for our customers. So really happy to be here. Thank you.
Great. Go ahead, Troy.
Thanks, Peter, and thank you, Jennifer, as well, for setting this up. My name's Troy Demmer. I've resided in this region for about 13 years now. Originally grew up outside New York City, in New Jersey, but Grove City College and then Carnegie Mellon kept me here. And so at Gecko, where I co-founded the business with my partner, Jake Lucerian, we offer a unique combination of robotics and software that captures, analyzes, operationalizes the physical data that defines success and failure in some of our most critical industries. And these industries include customers like energy, manufacturing. We serve 150 customers in the our power plants, oil refineries, consumer paper products, and our U.S. Department of Defense. Our tech stack, again, is software and hardware. And so our initial use case is infrastructure inspections, and Gecko is able to capture the highest fidelity and densest data sets with upwards of 100,000 times the richness of data that's ever been possible before. And that's where robotics comes in. And we do this at 10 times the speeds of any conventional means. We've developed these robotic platforms. We've named them after this Gecko subseries that can be found in nature, subspecies rather, that can be found in nature, like Toka and Ava. And these robots feed our software, and our software is predictive. And so what it enables our customers to do is maximize both the useful life and the productivity of their current infrastructure. And over time, we are informing the future of infrastructure as well, and designing it in mind for things like maximum observation, resilience, and ease of intervention. And that's Gecko Robotics. Thanks.
Great, Zach.
Awesome. Reiterating the thanks to Jen and Peter for organizing this, Peter for volunteering to interrogate us for the next hour or two. So I've been investing for about 10 years. I started my career at Kleiner Perkins, or investing career at Kleiner. Also spent a couple of years as a partner at BMW iVentures. Actually, the picture behind me is a bunch of cool robots assembling a car body at a BMW plant. And now I'm a partner at G2. And we spun out of Kleiner about 5 years ago. Our focus is on investing in technology companies that are helping make traditional industries more sustainable. We look for tech that's helping industries like transportation, ag, energy, supply chain logistics, helping those industries do more with less. Robotics is an important component of that, and that's why I'm excited to be here today.
Thank you. So Gren, appreciate the panels taking time out of their schedule to participate. I think it's definitely an interesting time to be having this discussion. I think it's interesting times, generally true more broadly, but particularly so within the robotics space. I think to Charlie's point, robotics have come a long way of late in a short time, and that's relative to the much longer history as well. I think certainly we've all experienced that COVID has been an accelerant of, some of those pre-existing dynamics. And certainly it's, my expectation that despite all the progress that has been made in, the last year, 2 years, for most businesses in technologies and applications, we're still very much getting started. And that said, we find ourselves, grappling with pretty unique set of variables. On the one hand, there's probably never been more interest in terms of investing in the space. And that's, both from just the investment side, but also the customer perspective as well. And that's continuing to grow the universe of interested investors in robotics. On the other hand, I think we're also dealing with an environment where interest rates are as high as they've been in a generation, future growth being discounted. That means that there's an ongoing, price discovery exercise that's taking place in the market as expectations are getting reset and all of the parties kind of recalibrate around, it's a very fluid environment. So, those competing narratives, I think, set up for an interesting backdrop for our discussion. And so to that end, I think our panelists bring unique set of experience and perspectives. Hopefully we'll get to a lot of the topics we intend to cover today, but certainly if there are questions that you have, as Jen mentioned, throw them in the Q&A and we'll save time for those at the end. So with that, let me get started. Charlie, we'll start with you. So you're at the finish line of your Series A round for Gather AI, and to the extent you can share details, it'd be great if you could give us some insights on the round that came together, how it took shape, some sense for kind of investor engagement, where this round gets you, and perhaps some of the key learnings that you're able to share from raising capital in today's environment.
Yeah, absolutely. It was definitely a roller coaster, but very happy to be at the finish line and expect an announcement from us real soon now. We'll talk a lot more about it. We went in the spring planning with really high hopes. I mean, the market was still strong. Macro hadn't yet come down to early stage financing. And with announcement lag, you're still hearing about really big deals with awesome, 50 to 100x valuations. Gecko raised an amazing round. Agility raised an amazing round. Zebra's buying everything, And that's kind of like the context. So the night before we actually launched our fundraising in May at the Cascade Connect conference downtown. And the night before, I spoke with one of our board members, one of our investors, and several other board members concurred that we should cut our round size in half. And we're like, oh yeah, you don't know what you're talking about. We didn't believe them, of course. So, but we agreed. So we decided to run an A/B test, and of course, they were totally right. And it goes back to what you just said, Peter. It wasn't a down market, which is fine. It's just different. It was a falling market. Layoffs were starting to be announced, all kind of changes, and there's no price information. So nobody wanted to really make the first move, and we had to really pivot and try different approaches to get something to work. And we didn't know how long it would take. We just kind of ran as hard as possible. We met with 80 different firms, and in about 10 weeks, we got 3 term sheets, and we managed to create a nice competitive situation. So we're really thrilled with the outcome and feel very fortunate. And all the credit goes to the company and the founders. I just started with the Series A, and the team has built something truly amazing. So one thing that was really good for us is we had a term sheet early on from our Series Seed lead, Explorer VC, in our pocket when we went to market, and that was a really strong confidence builder that we can go and really be bold with our fundraising. And you'll hear all the details really soon.
Great. And maybe just as a quick follow-up to that, so as someone who's scaled businesses in the past with successful exits, to your credit, again, understand fluid environment. How do you assess kind of where we are today, based on some of your prior experience, and did that dictate your approach to kind of raising capital? Did you modify your approach from the way you've done things in the past, in recognition of the fact that investors may be focused on different things today than they were even 6 to 12 months ago?
Yeah, that's a great question. I think the key thing is adaptability. So right as we're getting towards the end of our process, all my Google alerts changed on my phone, and the first one is VCs are now flush with cash. And the second one is like public market comparables, and SaaS are doing amazing. It's like, of course, so to us, a year ago was a cash burning contest, right? And I'm like the last person you want to hire to run that kind of company. Where I come is very much more smart growth, experimental, data-driven, incrementalism. It's like Rich Harris School of Business, where it's definitely it's an area of balancing growth with profitability, and making sure we have a sustainable business. So it's all about running experiments and knowing the paths, your FMEA in either case, and being able to adapt to a changing environment.
And Troy, for you, I know Charlie alluded to it, but you completed a sizable Series C round in March of this year. Can you share a little bit with us on kind of how that round came together? Anything you're able to share around the dynamics, in particular, were there particular milestones that you were funding to, the new investors that you brought on board, how you think maybe they add to the profile of the business?
Yeah, absolutely. Gecko's Series C kicked off probably about November of 2021, from my recollection. And it was in line with our past fundraising cycles. We also had a lot of confidence internally as well. We had some insiders that really wanted to, lead around and get the round going. So there's some similarities there to what Charlie shared. And over the next 3 months, that Series C played out. We raised $73 million. We brought in a new investor in XN out of New York, really helping us think about the next round in terms of, and also just public markets. And so that's an area of expertise for them. And, in terms of some of the milestones that you'd asked about, we're looking at just expanding our mission, and there's like 2 vectors to that. The first vector is just increase the breadth of our business and, increase access of our capabilities and our offerings, not just here within the US. I'm investing a lot in our sales and marketing efforts and growing our distribution channels, but also internationally as well. And so we launched an office in the EU, being our second region of boots on the ground investment. And that was in tandem with Siemens Energy. So they actually are licensing our technology and helping as a go-to-market partner. And so that was a different business model for us based upon what I described in our opening. So that was great and enabled us to properly invest into that, building robots, putting boots on the ground, investing in an office there. And we continue, we are going to continue to do that, open up new regions of the world. And then the second vector that I mentioned is going deeper with our current customer base. We're decoding the physical world by gathering high fidelity data that really helps inform the future, information that they've never been able to see before. And how do you really connect that to the larger business outcomes? And so going deeper with our current customer partners, building on top of our tech stack, especially in that enterprise software layer, pulling in other sources of data into our data pipelines, the data layers that we're creating, that's creating a lot of extensible value for our customers. And so we wanted to continue to invest in those two areas for the business, into the 2022 and beyond.
Great. Zach, maybe a question for you. At a high level, I think both Charlie and Troy have had kind of different experiences on their recent rounds based in part on kind of stage and maturity, but also timing. I think, Charlie made reference to, rounds priced last year versus this year, given lagging effects. Certainly that has implications for, valuations and appetite and the like from the investor community more broadly. But maybe from your perspective, can you give us a sense for your approach to kind of the current market, from the investor standpoint, how you're discussing today's landscape, maybe both internally with, some of your existing portfolio companies, but also, how you're thinking about new opportunities?
Yeah, sure. You said a different environment this year. Truly some whiplash between last year and this year. And I'm sure Charlie and Troy have felt that probably more acutely. So generally, we kind of think about market cycles as happening in three pretty distinct phases. There's the first, and this is what we saw in 2008 and 9, and probably what we expect to kind of see roughly this time. First is the crash, and this is when public markets are in free fall. Charlie talked about not just a lower market, but a declining market, kind of that phase of consistent decreases. During that crash, private valuations maybe not haven't reset in the way that you'd expect. You might see fewer rounds happening or rounds happening slightly smaller, but valuations haven't really changed much. Next phase is the turn. And this is when public markets have started to recover. IPO window probably still isn't open. But at this point, private company valuations have come down. They've corrected. We start to see down rounds, even for great companies, inside rounds, flat rounds. Some companies can't raise at any price. And then that leads to a third phase in a cycle, which is recovery. At this point, public markets are back to what they were pre-crash. Private markets are starting to see more deal volume at recovering prices. That's a really fun time, great time to invest and to start companies because there's abundance of capital and at increasing prices. I think we're still in the crash, probably. Public markets are still declining. Today's an awful day. Tech stocks more than publics. And so I guess the question is kind of what does that mean in practice and what are we seeing and doing? For portfolio companies, advice is kind of the same as always. Spend efficiently on growth as long as the unit economics are attractive. Charlie was kind of spot on. I think he talked about smart growth, experimenting, balancing growth and cash burn. We don't give out prizes for burning the most cash as quickly as possible if it doesn't lead to growth at attractive economics. Other advice, don't run out of cash, fundraise early enough to avoid running out of cash and have enough to get to a next milestone. All of that is pretty consistent advice during any cycle. Another thought just about valuations in portfolio companies is, there's a mantra out there that flat is kind of the new up. And, we've seen this within our portfolio and with companies that we're looking at investing in too. Companies that have, crushed their plans from last year, doubled or more year over year and are looking to raise flat rounds or modest step ups, that's the environment that we're in. And the most important thing is to be, funded and be in a position to compound revenue growth and continue on a trajectory to be an awesome giant company.
That's helpful. Yeah, and you made reference to this, but just a quick follow-up just on the question around unit economics. I think, certainly hearing, more regularly that, we're in an environment now that's prioritizing profitability versus hyper growth, and certainly with a greater emphasis on unit economics and in particular how that, translates into, a credible path to more near-term profits. Is that consistent with your view of the landscape today? And, if so, are there kind of, certain models or businesses that, you're prioritizing kind of given that assessment of kind of the landscape?
Yeah, good question. So it's tough to talk about kind of wholesale. Is there market pivot or not market pivot? I think to the extent that there is a focus on unit economics today and better unit economics and path to profitability, it's probably just because there's less interest in stuff that has obviously bad economics. And, we'll never pick on specific companies, but like as a category, we saw a lot of businesses that are in like instant delivery, companies to get your shampoo within 10 minutes. Those businesses generally have bad unit economics. They raise a lot of capital. I think they will have a harder time in today's environment because on balance, more investors are more focused on unit economics, and some investors that were willing to kind of look past poor unit economics aren't as active today. Fundamentally, in the end, companies are valued based on future cash flows. It's just net present value of future cash flows, going back to basics. And having future cash flows depends on having great unit economics. So I guess like in practice, or going back to practice, if we're in a market where capital is really cheap and future growth and future cash flows aren't substantially discounted to today, then you can spend a little bit more efficiently, and you can kind of dial forward how much you're willing to pay for future revenue. When we're in a market like today, where funding is expensive, or in some cases just really hard to come by, impossible to come by in some cases, it makes sense to dial things back and only focus on the most efficient growth, the highest quality growth. So there's never a kind of a black and white, this is good unit economics, this is bad unit economics. It's all in the context of how much capital can you raise over what time frame, and what is that giving you in terms of future growth. I see us as in a dial back environment. Our portfolio companies are generally seeing us in a dial back environment too. That's the posture we're taking, and when things change, we'll dial things forward and put more fuel on the fire.
Great. Troy, maybe I want to come back to you with a question, something you made reference to, kind of in your prior comments, just related to, your recent round, but also within the context of, your existing investors. So, you brought in XN, which is, a multi-strategy, hedge fund that's been active across both stages, but also the robotics space more broadly. Prior round, you brought in Drive Capital, who I believe led your Series B. Along the way, you've also, brought in Next 47, which is kind of Siemens venture capital investing arm. You talked a little bit about, some of the collaboration with the broader Siemens enterprise, but wondering if you could just talk a little bit about maybe your approach in this round, but also, how you kind of view it within the broader kind of life cycle of your business, and in terms of, how you prioritize particular investor characteristics at different stages.
Yeah, it's a great question. And, every stage that the company has progressed, I think the intentionality around the right investor for us has been important in what we optimized for. So I'll probably tell an anecdote all about each one, starting from the beginning. because we love them so much. But our first round, the earliest days of Gecko, actually brought us away from Pittsburgh to Silicon Valley, and Y Combinator gave us our first dilutive funding source. And that was just an amazing incubator, made us think much bigger about the problem we were solving. And the advice they gave us rang true throughout our history, which is build product and talk to customers. And just phenomenal kind of backing for Gecko, and it had introduced us to a lot of our now more growth stage funding investors. And so in our Series A, we actually went and in each of these rounds after that, we had options. And so we really wanted the right partners, those that would grow with us, those that gave us the right things that we needed at the right time in the business. So in our Series A, we went with Founders Fund because of the way they thought about building really big transformational businesses, and specifically around their thesis on like hardware enabled software, and just some of the most impactful companies that can do both of those things really well, the value that unlocks. And also they're very lightweight approach, and they don't take a board seat usually, especially at the earlier stages. They're very founder friendly, and they really allowed us to run our business. There's a lot of things we were figuring out at that stage about our product market fit, and we're going into these very complicated industries, very antiquated industries, and so there's a lot of things that we needed to figure out. And that was a great round of funding that helped us focus on the customer problems that we were solving and gave us the runway to do that. And then in our Series B, we wanted to bring on a board member, some outside governance, some thought partnership there. And we surveyed the landscape. We had term sheets in Silicon Valley, and the one we went with actually was in Columbus with Drive Capital and Mark Kwame. And we really wanted that local presence. We drive out to Columbus, he drives to us, and it's nice having someone in our backyard. Certainly understands, Silicon Valley investing, coming from Sequoia and founding Drive Capital, but they've been a great partner for us. And then in the latest round, we were really optimizing and thinking about what does future look like? Like, how do we think about the public markets as we start to go into later stage growth stage funding? Probably a few more private rounds, of course, but finding an investor that sat across those spaces and could really help us with not just introductions there, but how to think about it. What are the right types of aspects and characteristics of a business that looks ahead to being public. And one more that you mentioned with Siemens Energy, they have they're the sole LP in Next 47, and they came in our Series B round, and we had historically stayed away from strategic money, and we actually didn't even really view them as a strategic. And we wanted to be independent of our customers. We wanted to do the right thing for the most amount of customers, and not be beholden to one. But them serving so much of the energy industry, infrastructure at large, we felt that they gave us a unique perspective on the world. They had a lot of data that they were collecting, a lot of insights, and so we found them to be very valuable thought partners on our journey as well.
Great. And Charlie, maybe continuing on that point, relative to some of your recent discussions, obviously strategic investors, I think, can bring value when there's kind of proper alignment. They can accelerate certain initiatives, whether it's, with particular customers or, with the product roadmap, whether it's penetrating new markets. As Troy mentioned, maybe there's at times perception of conflicts that also get created there too. So you need to balance that out. I'm just curious to what extent that was part of, your discussions around your recent round, and maybe how you might think about that going forward.
Yeah, great question. We love strategics for all the collaboration reasons you mentioned, and also because they really understand our space, they understand our market, our customers. On the one hand, we do something super complicated, which is we have autonomous drones that fly around warehouses by themselves. It's like science fiction. But on the other hand, it's simple, right? There's stuff lost in warehouses. There's 150,000 of them worldwide. They have $100 million of inventory each one, and 10% of that, or $10 million worth of stuff, is just lost. And they really embrace that, the problem set and the vastness of, in our case, supply chain. So that was really great. What we kept hearing on paper, it didn't work out with strategics. I think for a seed, it's really easy because it's small and lower risk. And for a Series B compared to an A, there's a lot more data about the business. It's, you get into growth mode. But with an A, it's sort of a tweener. And Series A investing, I hear, is as much of an emotional gut call type of thing as looking at data, analyzing the market, the usual playbook. And we kept hearing is like, hey, we want to lead your next round, which to me felt like, hey, I want to be your next spouse, like after you're rich and famous, which it's not fair to them, but it wasn't a fit for where we are. And I'm curious to see if other people would have a similar experience. Similarly, I'll say that top shelf investors, your stereotypical, the big names, also weren't a good fit because most of them are kind of crypto crazy or looking for traditional SaaS plays. And we're just weird enough, even though we are like a pure enterprise SaaS business model, like in every way, we're just different enough that wasn't great. And for us, more of the like focused niche investor, I think is where it's at. And we absolutely love the lead that we landed with. We think they're amazing, real straight shooters, super easy to work with, and we think they're going to be great board members moving forward.
And questions we asked about, previously to Zach, just around kind of this question of, investor expectations around, path to profitability sooner. Obviously, you're, earlier stage, still very much in growth mode, but, just interested, was that part of your experience? Was that part of your discussions? Did you make any changes to kind of your approach to whether it's the financial model or how you talked about the opportunity with investors being more mindful of kind of that dynamic?
Absolutely. And I joined the company just before we started fundraising, so I had just evaluated it with my enterprise like B2B SaaS rubric, and I had that fresh look on it, and that really paid off in spades. And that's why I joined, because the company was so strong to me financially, and we were able to tell that story. So like our key innovation, if there's one of them, is that we can make autonomy work on consumer grade commodity hardware. And I think that's what really enables the entire business to scale, right? Like we have a path to 80% gross margin, recurring revenue, super sticky customers who we love and are amazing. And that was, I think we would have a much different story if we were building robots and doing the stuff I used to love to do before I became a Gmail and PowerPoint person. We had a profitability plan in the beginning. I actually had a friend who's a VC tell me the opposite. It's like, never use those words in a pitch meeting. Like, you need triple, double, double, double. I'm like, I don't know. I don't believe it. But that was in our model. And what we made clear to investors is, look, spreadsheets are as good as, they're what we pay for them. But like, what is the independent lever in your P&L, in your forecast? And to us, it's burn. And it's preserving optionality, right? We got to be default alive. In this market, you don't know when it will end. You don't know if you can fundraise again. And to us, making sure that we're making smart investments with our capital in measured strategic things. And also, you can't, if you're too conservative, then you create too much opportunity cost, right? You can lose out by playing it too safe. So finding that balance and kind of over communicating with your stakeholders is really key.
It's helpful. And Troy, maybe turn it back to you. You talked a little bit about kind of the different profiles and perspectives you get from the backgrounds of your investors. And I'm kind of curious, maybe if you can give us some insight today in terms of, how your internal discussions are going with, some of those investors. Obviously, you've raised a large amount of capital. You've got a great amount of runway. Presumably they also have perspectives on, where we're going from here. Probably some more optimistic, some maybe more cautious. But curious, how they're talking about, you and the way you run your business in this environment, just given, all the dynamics that we're, kind of grappling with in the amount of uncertainty.
Yeah, great question. And this feels like round two now, because, if we backpedal to, the start of 2020 and, into March and April, we had the same series of conversations happening, major contractions in the markets, liquidity crunch, people aren't, physically going anywhere. So it, had some massive repercussions throughout the entire, value chain. And so, Gecko's kind of operating philosophy, and from day one, I think we had this instilled in us, especially as developing hardware, which can be very capital intensive. We really make sure that are, the data layers that we're pursuing, the end outcomes that we're pursuing will pay off. And we do that in close proximity with our customers so that, we spend our forward-looking R&D in a way that's going to create value. So I think, some of the things that have underlined just kind of our operating principles from day one is like, we should be capital efficient, we should be disciplined and focused. That being said, our mission has never been more important, which is, to protect, our current infrastructure and, inform the future. And, more capital is being deployed than ever into this area, just whether it be government funded or, private sector, as people realize a lot of the infrastructure that we have needs, a life extension on it. We need to get more productivity out of it, especially with the supply chain concerns and the labor challenges we have. Building new is difficult, and if you can use existing footprints, existing infrastructure, there's a lot to be optimized there. There's a lot of value in assets that have, at times been overlooked. And so, our focus is on, creating value for our customers. If we create value for our customers, we're going to create value for, the company and our investors. And so we've not changed really at all. I mean, we constantly calibrate, looking ahead 12 months or, and then 3-month increments, like where are we spending our resources? And, are these bets paying off? We should be making some bets that, don't pay off, but we should cut those losses early. And I think for us, it's just been a disciplined approach, a capital efficient organization where we go typically 2 years between our funding cycles, and, we achieve, some really great growth in between those periods. So for us, it's kind of business as usual. Obviously, we're looking at, other, macro factors, but overall, we're still charging ahead like we've always been.
That's great. And then maybe just turn it back to the kind of investor perspective as well here. Zach, I think as you again see, it's a very dynamic environment. Also see some of these dynamics that kind of, predate some of the current challenges, but, within the kind of venture investor community, I've certainly seen an emerging dynamic where both kind of later stage investors were kind of increasingly allocating funds into earlier rounds. And I think we're also seeing a dynamic where, traditional earlier stage investors are raising growth rounds to do, follow-ons and support growth of existing investments, as well as, newer investments at later stages than they've previously been involved. Kind of curious as, specific to G2, in today's environment, are you, similarly expanding the kind of aperture of opportunities you're pursuing, either from kind of a size or stage perspective, or are you refocusing on kind of what you consider, the core of what you guys are good at?
Yeah, that's a good question. We are definitely being opportunistic with things that we're pursuing, but I think it's still in the kind of schema of our core. So we have a pretty wide range of investments that we look at in our portfolio. Companies have ranged from a few million of revenue to a couple $100 million at the time of our investment. But there's a common thread throughout all of those, maybe 3 common threads. One is technical risk has been removed. So there's a product and it works and it's in customers' hands. Second is those customers love the product and we can talk to them and they rave about it. And then the third is that there's kind of data and history to evaluate. And Charlie talked about kind of Series A investing being emotional investing versus data driven. Fundamentally, I do think that there's a difference between what makes a good late stage investor and what makes a good kind of early stage and seed investor. I'm on the later stage growth investor side of things. I would probably be a bad seed investor. In fact, actually, I know I would be. I've had 2 friends that kind of come to me over the last few years with kind of serious conversations about companies that they wanted to found. They pitched their ideas and were more just looking for friendly advice. I told them I had no idea what they're talking about. I actively actually tried to convince one person to do something else. And now those 2 companies have a combined like $6 billion of enterprise value and they've raised $1 billion. So, and I'm on a panel about robotics. So I would not be a great seed investor. But I guess where I'm going with this, like I like the way that Troy described kind of having a very deliberate approach for what you're looking to get from various stages of fundraising in various fundraisers. And there's no one size fits all kind of investor profile or firm profile that works for companies, but it's about, what does a company need at a certain stage, and will that investor bring it? And our goal is to kind of be the most strategic, non-strategic investor on a company's cap table, most supportive of BD and product conversations, et cetera. And kind of expanding too far outside of a core, probably is hard in the best of times and harder in harder times.
Mm-hmm. That's helpful. And then I think as maybe a follow-up to that, just as you kind of assess the robotics environment today, certainly over the last 12, 18 months, a lot of money's gone into warehouse logistics, fulfillment technologies. A lot of technologies have matured and improved over this period and proven themselves out. But as you take stock of the landscape, are there new areas, new use cases, new markets that are maybe less developed that you're particularly excited about or focusing more time on?
Sure. Before actually answering about new topics, I just want to first start with I am incredibly excited about the kind of logistics and warehouse environments that you talked about that kind of feel more mature. Our kind of whole investing thesis is that after, there's the tip of the iceberg, which starts to feel mature, but really the bulk of value to be created happens after that point. We like to look at Tesla actually as an example of this. They went public at around the time the Model S launched, or just after the Model S launched. And that was kind of their moment when they hit, that first stage of maturity where, they had a product that was out that was selling a lot. And so the question is like, where would you rather be? Would you rather be in that kind of pre-commercial, pre-IPO investor or post-IPO investor for that company? And if you were a Series A investor in Tesla, you would have made about 10 times your money to that IPO. If you invested in the IPO, you would have made over 200 times your money through today. And I think there will be a similar dynamic for warehouse and logistics related companies where, a lot of the technical risk, a lot of the early commercialization risk has been removed over the last 5 years. And the next 5 to 10 years is when there's just going to be, dramatic revenue growth, dramatic gross margin growth, and a boatload of enterprise value being made. So that aside, there definitely are areas that I find are interesting. The two that come to mind are in energy and in ag. Troy talked a little bit about energy, but just generally, you have huge catalysts like Inflation Reduction Act causing trillions of dollars of spending in new power generation modes, specifically wind. I think over the next 10 years, there might be about $1 trillion of total capital invested. That's a lot of turbines. They need to be inspected, regularly repaired, maintained. Getting people to climb those is very hard. And as you have more of them, it will become harder. So I think robotics is going to play a huge role there. In agriculture, over the last few years, robots have definitely gotten better at working in unstructured environments. So they're becoming more reliable in crop fields. Those fields are also pretty inherently safe environments. You can always just stop. There aren't a lot of people around. There aren't a lot of other vehicles around. So I like those two areas. Generally, we're always looking for like a cross section of kind of reliability and having robots that work in an environment, and then demand. Are there enough customers willing to pay enough and getting enough value from the product? And ag and energy feel like they're starting to be at a point where across those two measures, things are getting very interesting.
Great. Troy, I know we've talked about certainly challenging dynamics within the market, but I'm also curious to get your perspective. And maybe I have a couple questions here just in terms of where this current environment we find ourselves in today may present opportunities, either from the standpoint of attracting talent, or perhaps are there opportunities that you guys are more focused on in terms of acquiring businesses that may allow you to accelerate your product roadmap that might not have been available 6 to 12 months ago. Curious as to how you guys are thinking about that from an opportunistic standpoint.
Yeah, interesting question. The way that we think about this is there's, macro shifts happening around our customers and how they do business as well. So I'll add something about that piece in addition to the two questions you asked. So I think on the talent side, it's it was a very competitive market there for a time being. People were asking for some very maybe inflated type of comp packages, and just overall there was a very large amount of shifting going on between companies, and there was ultimately more jobs than there were people willing to fill them coming out of COVID. And I think there's a balance there, right? You don't want it to be out of equilibrium on one side or the other. It really should be balanced. And I think we're starting to hit that equilibrium point again, where it's both sides have sort of an even fair shake at it. And that's where, Gecko thrives, I think, of being an attractive place to work and, being a tech company that's got high growth and a really important mission that we're solving. And so we've seen hiring become a little bit easier. And I think, you could maybe, expand that out a little bit and say, some companies may not get funded in the future, or, contraction will further happen, and, maybe resources are allocated to the best companies. So, that's something that, we'll see how that plays out. On the customer side, it's really interesting because there's been acceleration to automation, a lot of early retirements, a lot of, there's kind of like a bimodal distribution in our customer base, where you've got people towards the end of their career, and then you have some newer entrants, but there's a lot of subject matter expertise. There's a lot of knowledge that are leaving towards that more elder stage of that bimodal distribution. And so with that, that opens up the thinking to be innovative, that opens up the thinking to do new things, but it also is leaving a real gap in terms of knowledge and skill about how an industry should operate, what the operating system looks like, that sort of more reflexive, intuitive decision making is shifting to data-driven decisions and accelerating digitization. And the industries we work in are arguably a laggard in that. And so we're actually very excited about the adoption that we're seeing around not just autonomy and robotics and safer, more scalable means of data collection, but also embracing data and digitization and cloud. And so it's been a tremendous benefit for us, and we're excited about the potential that means to accelerate our product adoption.
Great. And Charlie, I want to come back to you, something you talked about at the outset, just in terms of your model. So I want to get your perspective on kind of full stack robotics models. Understand that both for kind of companies, investors, there's this increasing acceptance of a view that hardware is certainly important today as a means to kind of deliver a productized solution in some instances, which makes it easier for customers to adopt newer technologies. But over time, that the differentiation is going to come from the software rather than the hardware. Curious as to how that factored into, I guess, your attraction to the business model, how it was developed. I know some of that maybe preceded your involvement in the company, but also, the investor perception and reaction and enthusiasm for, kind of software only solutions, as part of your discussions in your recent round.
It's huge. Yes, I think software only robotics companies are the future, not to the exclusion of the traditional model that I've also worked in. But I think the industry is having its Google moment, where compared to the predecessors, Microsoft and Apple, enabled by commodity hardware, you can scale a company 10 times faster. And I think we're about to enter like the Cambrian era of robotics, where many more companies and more diverse companies are founded and can scale faster with less capital because they're software only. And if you just look at mobile robots, really drones are the only platform so far that are manufactured in the millions at consumer price points, like you can buy them at Best Buy. And I think one at a time, more platforms. I think mobile robots in like ADA, ramp, sidewalk type of environments will be next. but that's going to enable like a bunch of new innovation and a bunch of new companies. Like I see it as the industry matures, it's like a bathtub curve, where in the early days you have to have hardware because you can't buy what you need, right? And then even now the self-driving companies, Aurora, right, they're all investing in or acquiring sensor companies because they need to further advance the state of the art just to deliver their own situation. And it's amazing, right? I have so much admiration for the tech side of the house. But in the middle is like the Google era, right? Where everyone knows that story, right? They put millions of commodity PCs inside data centers, like that allowed them to achieve like unprecedented scale. And then in super late stage, I think you find it going back like the end of the bathtub curve, where now Google and Apple are making their own silicon, right? Because they have the scale to support things like that. So I think, I see us like one vertical at a time entering this phase too. And that's like what made me so attracted to the company. And that's what I think made us so successful at fundraising, because like everyone wants to know what the drones cost. Right now we're on $2,500 drones and we have $800 drones in testing. And meanwhile, we have customers that are pushing like 6-figure contracts. So the unit economics, they're they really are like software company unit economics, right? And we don't have the cloud costs that you do in your traditional SaaS company. So that has the scaling properties that we love, and I think it's going to change the game. But it's not easy, right? Like if you're a roboticist, if I can nerd out for a second, right? If you're going to use a drone from Best Buy, like you don't have access to global shutter cameras, right? You have rolling shutter cameras, which in motion you get a jello effect. We don't have synchronized sensors. We operate indoors in warehouses. It's a GPS denied environment. So commodity drones don't have laser scanners for localization, and you can't even use stereo vision, right? Because you only have access to the forward-facing gimbal camera. So we really have to do some serious innovation to make this all work. And for companies who can do that, I think there's a huge bounty for making that happen, and then a huge technology moat once you're there that protect your business. So little plug, we're hiring. So if you're interested, www.gather.ai, we'd love to talk to you if you want to work on that kind of thing.
Great. Maybe a similar question for you, Troy, but maybe from a slightly different angle. So, Gecko obviously from the outset developed some, very unique and proprietary hardware. But maybe can you give us a little perspective on, how your model is evolving over time, perhaps maybe from the perspective of, where you're committing R&D dollars, where you're focused on hiring, where you're putting other resources towards continued development today, versus, where you were in the outset.
Yeah, and I hope my hand raise emoji gave me another question there. I was trying to +1 to Charlie there because it was great points he was making. But yeah, we took a very first principled approach in terms of solving this, very complicated problem that has, quite an extensive tech stack to it. And we focused on creating the data layer that helped us close the gap. And, that meant, that using that bathtub curve analogy, we had to build a lot of hardware. We, integrated some sensors, we custom built some of our sensors, but we were really focused on kind of a, physics-based first principles approach of what is not allowing this industry, what is not allowing our customers we serve to answer the questions that they're trying to answer. And it was the fact that there was a data gap there. And so integrating hardware and sensors and software to power those robots and be intelligent about the data we're collecting, processing that information. That was huge point of emphasis for us in the beginning. And then it shifted into the enterprise software side. Like if this information today is only being viewed at low levels in the organization, what happened if we elevated this information to more senior people, the top C-suite, right? How are they thinking about long range decisions? They have a much more strategic vision about how the world operates and where they're going to make their bets, where they're going to get ROI. And the early days was people at the facility level sort of gathering data however they could and making decisions in a very reactive way. And so for us, it was a natural evolution to go up market and to continue to add our tech stack, largely in that enterprise software space. But it's an evergreen model for Gecko where we're constantly, evaluating new data layers that need to be created where there's gaps today. And that gets us into other modality type of robots, form factors, but also new types of sensing. And, we make sure that we're confident that it's a data stream that's worth collecting because the end outcome, the end problem that we're solving is so rich and so valuable.
And maybe looks like we have time for perhaps one more question. I'll just turn to Zach before we take any Q&A from the audience. Zach, interested in your kind of perspective on full stack software only, some of those considerations, but also maybe even a broader question of, where you assess where we are in terms of maturation of certain technologies, if that creates opportunities to, invest in, what I might consider like ecosystem plays, whether it's, hardware agnostic charging technology or, related, related pieces of the broader ecosystem. Is it growing to a point where it, makes sense to consider investments in companies that are serving the broader ecosystem versus, a specific solution?
Cool. I think there are hardware platforms. Certainly, there are ecosystem plays today. I think most of them are hardware, though. I was thinking, and Charlie mentioned, DJI as a perfect example of a hardware platform. They're kind of the de facto thing that you would use for a drone application initially, at least. Software has historically been harder. It just being difficult to abstract away the kind of hardware that is design controls from the software to deliver some valuable application to customers. I think that could be changing it. So I look at automotive as an example where, automotive autonomy is it's robotics on the road, and there are a lot of software only businesses, the kind of full stack AV companies, which are, they have kind of preferred configurations or architectures of hardware, but in a lot of ways they are hardware agnostic platform businesses. There are also kind of more pointed picks and shovels companies that are doing things like trying to take ROS and make it hardened for automotive use. And so I think we could be at the start of an age of ecosystem or platform businesses in this space. One issue has always been kind of value per unit and volumes. And in software in particular, the challenge has been finding a way to charge enough per unit to make a large business. And we're at a point where there probably are huge tailwinds in that the volume of robots is going to be dramatically increasing. So you can, you have an opportunity to build large businesses, larger than you could have in the past, just because volumes are increasing. So when I think about, if I were to start a company in that tried to, build a, not an application, but some kind of a ecosystem or a hardware software platform, the question would be, where is there going to be the most robotic volume in 5 years, knowing that that's probably going to be the area where there's, the most opportunity to build a large business that only takes a small portion of a kind of a per unit pie.
Great. Well, I think that kind of takes us to the end of kind of our panel discussion. I know we've reserved some time for Q&A. So Jen, if you have those handy and you want to direct those, I'll hand it over to you.
Yeah, sure. So there's still time if anyone has any burning questions, top of mind for the panelists. This was a very exciting discussion. So I know I was tuned in the whole time and learned a lot. So thank you, Peter, for crafting such thoughtful questions and leading the conversation. And thanks to all of the speakers as well for sharing, your experiences and your points of view. It's really invaluable, with the rate of growth that's happening across all these different industry sectors with automation. It's, I think, important, to be able to have these dialogues and share that with the broader audience. I know we have a lot of global attendees as well. So thank you for that. So let's turn it over to the questions here. We have a few anonymous questions and some named ones as well. But one of the questions that we have here is directed at Troy and Charlie. Was it difficult raising money being a Pittsburgh-based company, or is that really less of an issue these days? So which one of you would like to?
I can share my perspective on that. So as I mentioned, Gecko did start in Pittsburgh, and we found that we needed to broaden our horizons, right? You just don't see the investor network here. And so getting to where the investors are is important. How you do that, is, you can do incubators, you can spend 6 months there and, start meeting people and getting the right introductions and connections that you need. We never felt pressure to stay in Silicon Valley. We had a few investors that said, hey, you're already out here. We only invest in companies that are based here. I think there's merit to that. I think one, there's ability to do, just interact and have the right level of engagement. I think there's also, probably a general belief that, where are the talent hubs? Is Pittsburgh a talent hub or not? Or is there the growth mindset there? And so I think there's, Pittsburgh needs to change that, right? And I think, companies like ourselves that are on here, Duolingo, these are the success stories that we need to fuel it back to Pittsburgh and say, there's a lot of great advantages of being in Pittsburgh. The schools that are here, the talent that remains here after going to these schools, is the competencies that we build. So, we think about where the investors are, where the talent is. Gecko has 6 offices across the US. So we're not just exclusively Pittsburgh, but there are some, tremendous, talented, bright minds here. And then, there are other pockets of talent that are in other places. So I think, you can totally get funded in Pittsburgh, but you have to get, out there and, hopefully we can create more of an investor network here. There are some firms here as well, but they're capped in terms of what they can do at different stages of a company.
Cool. Thanks. My experience was, if you're not a robotics company if you're from Pittsburgh but not a robotics company, it's probably an uphill battle. But in terms of robotics companies from Pittsburgh, I think our reputation precedes us, and there's a lot of awareness from, Uber coming to town, scooping up a bunch of people. You'll see Chris Ermson at Aurora, John Hurst at Agility, coming back home, right? And starting hiring here. So, I think we've arrived, in terms of are we on the radar of investors across the country, and it's just a matter of Matt Johnson Robertson. I saw him give a pitch at the Cascadia conference, and I'm going to paraphrase, but he said his slide said something that Pittsburgh robotics companies have the worst pitch decks and business models and the best technology of anyone in the business, and then Carnegie Mellon startup, I think specifically, and then Stanford startups have the best pitch deck and business plan and no technology whatsoever. So I'd rather be on our side of the house. We can fix that, especially through stuff like this. And I think the future is really bright. There's also, I guess last thought, there's a lot of Midwest focused investors. Drive Capital is one you'll hear about a lot, who are very reputable, very active, despite having an enemy football team. And there's lots of places where you can go. And I think that's a great place to start, is don't go to the top shelf, and start with people that are more interested in what we have to offer.
Great.
I'm going to jump in here too.
Yeah.
So, we think a lot about just where to find great opportunities, and we invest outside of the Bay Area all the time. Our second fund, which we raised last year, we have 10 to 15 portfolio companies, and only a quarter of them are Bay Area. So I think you'll find a lot of investors, even ones that are based in the Bay Area, investing all across the country. Also, we're in a Zoom world. This is a virtual conference. I actually live in upstate New York, even though my firm is based in California. I think just geographic diversity is much easier today than it was 5 years ago, and so I put less emphasis on being in the exact kind of quote right location today.
Well, yeah, maybe I'll share an anecdote. In our entire fundraising, we didn't have a single in-person meeting. And last year, at my last employer, we sold that company for 600 million, while they raised 800 million. And we also did a concurrent acquisition in the UK, and nobody met in person there. So don't feel like the airplane is a handicap anymore, and go bold.
Excellent. Great thoughts, great feedback. So we have a question from Andre, who wants to know, how will the large increase in government investments affect the market for robotics companies, whether that's in Pittsburgh or anywhere? And that's just open to anyone on the panel who might have any feedback on that topic.
My sense is it will create new kind of sources of demand. I mentioned kind of wind turbines and inspecting and monitoring and repairing those. there's also quite a bit in the IRA that talks about domestic production. And so to the extent that there's going to likely be a lot of onshoring of manufacturing and onshoring of things that might have happened in China or other lower cost countries, you'll see more kind of need and drive for automation kind of across supply chains as a result of that. So I think it will have a pretty serious net positive impact. I don't know if there are kind of direct subsidies for robotics in recent bills, but the kind of second order impacts are going to be huge.
Great.
I'll share perspective on this. There's we're a beneficiary of the bill that preceded the Inflation Reduction Act. So the infrastructure bill we've actually been able to put to work. And I think a lot of times the sources of capital are looking for the right ways to be deployed. They're not all figured out and allocated down. And so, whether it be, in our specific instance, it's working with areas within the US Gov on the Bureau of Reclamation side, powering like hydro facilities. And so, that money does trickle down. And I think there's ways to be proactive as well, which Gecko has deployed to be active to say, this is a need. If we could fund this, we could be able to improve our operational readiness as a country or improve our underlying infrastructure. And so there are ways to influence, where those capital dollars are being spent and ensure that, the gaps that need to be closed can be closed.
Yeah, totally. And I'll agree to that. We feel that really directly. We've built our platform to be drone agnostic. DJI, like Zach mentioned, they have over 50% market share and they're a Chinese company. And Chinese drones have already been forbidden from like US government military use. So, diversification is really important to us. And there's a renaissance of US drone companies. So that's directly relevant. I would caution you though, to get too into bed with that. If you're familiar with like shipping, there's the Jones Act. It's a law that says US port to US port shipping can only be done by US ships. And I think largely it's caused some, I don't know what negative word to use, but really like fat and happy, companies that can't really compete on a global scale. So definitely get a boost if you can, but make sure you keep your eye on a broader, like unsubsidized business model.
Great. Again, excellent feedback. Great comments. We have a question that came in here. This one's directed to Zach. As a later stage investor, how do you view strategic corporate investors who have a big position in a company from earlier rounds?
Sorry, it's muted. That's a really good question. And I'm going to give the most annoying answer, which is it depends. But I think, and I worked at a strategic investment firm like I said, I was at BMWI Ventures for a couple of years. And so I've seen what that model can be at its best. I also am aware of what it can be at its worst. In the cases where we see large ownership from strategics is really positive, those strategics are, helpful when it comes to commercial concerns, giving them revenue, giving them business, maybe helpful from kind of IP sharing, giving technology to startups. Where it becomes problematic is if there's any part of that relationship that constrains the startup from attacking a bigger opportunity. And there are relatively few strategics that kind of actively do that. But that's the main thing that I would look out for. It's hard to say from, just a percent ownership does it kind of border on problematic or not? It's really about the relationship, side letters, the nuts and bolts of commercial agreements between companies and their strategic investors. Net, I think it comes with more positives than negatives, but the negatives can be meaningful.
Great. Thanks for that. Okay, we'll go to one last question here. We have a question from Kyle. And so it's about talent, which Pittsburgh is known, I think, for having a really fantastic talent pool that companies have access to, especially for robotics, tech in general, and engineering. But can you talk about and this is open to all the panelists, talk about attracting and keeping talent to Pittsburgh to fill much needed senior roles, to run companies and make investors feel more confident that the right team is in place. And how does decentralization through technology play a part? And before you answer that, I just want to bring everyone to the chat very quickly. I will mention that Gather AI and Gecko are hiring right now. And so, if you know of anyone that is interested, or if you yourself are interested, there are links in the chat directly to their careers pages. Talent is, of course, a top priority to all these organizations and critical. So, all right, panelists, what are your thoughts on that?
I can start. There's such an amazing and vibrant scene there. I think people do want to stay, which wasn't true when I was a wee lad getting out undergrad in 01. I think it's changed a lot, both in terms of like things that are appealing to young talent and opportunity. So I think just give people an excuse to be there, and they'll gladly stay and participate and help grow the scene. University recruiting is important. Getting your brand out locally, like your recruiter brand, by doing stuff like this, I think is really important. And I think it'll be fine. In terms of attracting talent to Pittsburgh, like that can happen. I don't know if I'd call it an uphill battle or not, but I guess I would reframe the expectation, which is most tech companies these days are distributed. We're distributed, like I'm in Miami right now. And for us, like as a forcing function, the people who touch the robots have to be in Pittsburgh. That's where our testing site is. That's where we build our autonomy. But most of the rest of the company is distributed all over the world, and we're happy to work with people where they are, and get together in person as needed.
I think Charlie nailed it. So thank you for the plug on the careers pages.
Absolutely, it's important, right? It's an important component of running a business. So, okay, so that concludes the audience Q&A portion. And so just as a recap, right? One, I just wanted to say thank you so much to Cowen for being an excellent supporter and partner, right, with our community, with the network, and across industry. Thank you to Peter for crafting this thoughtful discussion and having excellent questions, engagement, and leading the conversation. And thank you to Zach, Charlie, and Troy for joining us today and sharing, right, your experiences, your thoughts, and just these invaluable tidbits of what you're going through, right, what the look ahead is, and what's top of mind for you today. So with that, the Pittsburgh Robotics Network would like to conclude this virtual event. And I'd like to thank everyone of you in the audience for tuning in today, or if you're watching this on a recording, wherever you may be, whatever time of day it may be, thank you so much for joining us. Please don't hesitate to reach out to us if you have any questions or want to get engaged with our phenomenal Pittsburgh Robotics business cluster. And you can always check us out, like I said before, on our website at robopgh.org. So thanks again. Take care. Have a good day or night.